You can sense it out there that it's coming. And I think the crisis, particularly the breaking of the US stock market bubble, will help further that. And I also think that the price of gold is likely to go parabolic.
Okay.
Not no more of this arm wrestling, 2 steps forward, 1 step back type stuff. And I think if, for example, gold right now is 2340 area, it's been above 2400 in May and June, and again in July. It might be over there, April, May, and June, and maybe July it'll be above 2400 again. If you go up over 2400 again, my bet is gold starts to go parabolic. In which case you don't move in hundreds, you move in, you could move $1,000 very rapidly. And I think silver will outpace it.
Welcome back to the channel, and I am delighted this week to have somebody that I've been trying to get on the channel for a while. I'm really excited to introduce you all, if you don't know him already, to Michael Oliver from Momentum Structural Analysis. Michael, welcome to the channel.
Good to be here, Dave.
Now, I want to start off by just setting the tone here so that people understand the difference between traditional technical analysis, where we look at price action, and momentum structural analysis. So can you just kind of level set for us on that?
Well, we've been doing it for 32 years now. What we did is, I used to be a futures broker back in gold was legalized 1975. I was with E.F. Hutton, and I learned the normal bar chart type technical analysis. You draw lines on price charts, and you look for what? Structure, something to break, right? Okay. Well, what we do is we've learned over the years that quite often momentum will lead price in a new direction before price even gives you a hint that it's about to chop your head off or explode, one or the other. What we do is we measure price action in its relationship to certain averages. I don't mean by overlaying an average on a price chart. Any idiot could do that, and crossovers of moving averages are sometimes coin tosses. They don't mean anything. What we're looking at is when we plot our momentum charts, where we oscillate price in relation to, let's say, a long-term average, like a 36-month average, it's a 3-year, long-term. We get a pattern of action that's different from the bar chart action of price. Quite often we'll get a divergent view of reality there. And almost always momentum will top before price will and bottom before price will. I'd say, 90% of the time. So what we're looking for is analyzing the technicals, but of momentum first, price secondarily.
Okay.
And it gives us a heads up, I think. And I think our record speaks for that.
How do you determine momentum? Is it just looking at the long-term averages?
You're doing essentially some of the same things that price folks do, which is to say, if you've got a market that hits the same level 3 times in a row, a floor, and you break it, well, that's negative, right? Okay, for our price chart. Well, sometimes you'll get that same floor, but you won't see it on price, but you'll see it on momentum. Where price doesn't have the floor, therefore you can't plot it, and yet on momentum there's this floor, and therefore you heed momentum on the assumption that price will follow it, and it almost always does. But we don't use the metrics that you can get free on your computer screen, the MACD and RSI, the little wet noodle type things. We're looking for crispness, structure to break, just like price chartists do. And we look at different timescales. You look at a long-term trend of a market, and you look at the intermediate term trend, or even short-term. And sometimes they're different. A market can be in a bull trend, yet have a correction, right? Okay. Anyway, so we try to interface those together and get a good view of any given market.
And then if you take momentum structural analysis, what is that showing you at the moment with respect to global financial markets as a very broad place to start?
The 4 major asset categories are the stock markets. We're focused on the U.S. market because it is the bubble. It's the one that went in geometric terms since 2009 low, went up far more than any market in the world. Of course, we did our QE for a decade plus, so we printed it higher. Okay. But Europe didn't create a bubble like that. China didn't create a bubble like that. But we have a bubble. So we're very focused on the U.S. stock market because we know when it breaks, it will have wave effects. on Fed policy, on interest rates, and on commodities, but especially on gold and silver.
Mm-hmm.
Because once you break an asset category that the central bank does not want to have broken, with the consequences that usually come from such breakage in the stock market, what's the prime beneficiary? Monetary metals. Because again, they turn to monetary policy to try to hose down the fire that they created. And that means massive liquidity, lower than normal rates, et cetera, meaning degradation of the money unit.
Mm-hmm.
And therefore, gold is the beneficiary.
So are we talking in terms of the bursting of the stock bubble in the US? Is that something that is imminent, or is that something that's going to play out of the, okay.
In fact, in 2022, first of all, the market, most indices or sectors topped in late 2021 to early 2022. I'm talking US market now. Okay. Had a nice drop into summer and then October of 2022, about a 25, 30% drop, depending on the index. Not a full bear market, but, a hefty drop. And it's taken them 2 years plus now to get some of the indices, the front end loaded indices, where they have NVIDIA, Microsoft, Apple, etc. Like 5 symbols explain the entire index's move, has managed to get above the 2022 highs. And we turned major long-term negative, get out, we said, in January of 2022.
Mm-hmm.
And it took it 2 years to come back up, and now it's taken that out. So people said, oh my gosh, it's going up forever. No, sometimes stock market tops are very laborious. If you go back and look at 2000, late 1999 through 2001, the market labored for a year plus.
Yeah.
2007, it labored for a whole year before finally breaking in 2008. This time it's longer in the laborious topping process with, again, a marginal new high. But that makes sense because the bull market is 3 to 4 times older than the other ones in duration, and 4 or 5 times more in percent gain. So the bigger the beast, the bigger the top. And bigger the top, the bigger the drop. So there's a lot of negative consequences built into this error of pricing, of massive overpricing of the stock market based on monetary factors like Fed funds rate, monetary growth, et cetera. When the bubble breaks, the Fed always comes in and starts cutting rates. They did it in 2001, first day of January, not far off the high. 2007, it was in September of 2007, they cut rates. Market went up for 4 more weeks. That was the top. Once the Fed makes that decision to, we need to cut rates, something's really wrong. It's not good for the market, okay? So everybody's sitting here cheering that the Fed's going to cut rates. Don't cheer for it, because it means that they're scared of something. And I think one of those factors right now is something new. It's the yen.
Play that out for me now, the problem with the yen and how that's actually impacting.
Well, see, they have these 2 mandates. There's the employment one and then there's the, quote, inflation one, as they narrowly define it. And they can often be contradictory, where you've got maybe some rising inflation that they're trying to fight, quote unquote, and not their monetary expansion, but the price of certain commodities, let's say. They don't mind it when stock prices inflate, but they do mind it when the price of corn goes up. Okay. There's this other variable, though. And remember, you may not remember, 1997 and 1998, the Thai baht currency collapsed.
Very beginning of my career. Yeah, I do.
Yeah. And who cares? A Thai baht, so what? How does that affect the world, right? Well, it did. It finally affected eastern part of the world, and it impacted Russia, and then ultimately it knocked out long-term capital management, a big, huge hedge fund in the U.S. And what did the Fed do? They cut rates 3 times in 1998 because of that factor alone. Okay. Right now, the Fed has that new variable because the yen is not the Thai baht. The yen is one of the club members, Europe, Japan, US, okay? So when their major currency is in collapse mode, and you can go back back to 2011, it peaked. So it's been collapsing for 12 years, but a lot of that's occurred in the last 2 years. And that is going to have wave effects. They always, even Thai baht had wave effects outside of the currency itself. And the Fed, and no doubt the Bank of Japan and ECB are aware of this. And so far, ECB has cut. I think UK is going to cut. Canada has cut. We haven't cut. And it's our difference between our rate and the Japanese rate that is helping to assist the yen on the downside. So there's a big pressure for the Fed to cut rates. No doubt if they do, there's already some talk right now they may cut in July, by the way. That's some people talking about that. They're no doubt looking at the yen because they realize the Fed has to deal with that problem because it can get out of hand so easily.
Right. You're not the biggest fan of the Fed. Now, we've had a lot of rate cuts priced out of the market, and now you're suggesting that they may have to cut a lot more aggressively than what's priced in. And as I say, you're not a big fan of the Fed. You don't think they handle these situations particularly well. Would that be an accurate thing to say, or am I underestimating?
Well, I know. I think they tend to be a causal factor in the boom-bust cycles, that their monetary boom-bust policies create boom-busts in the stock market in particular. And when they go bust, it hurts people. Even people aren't in the stock market get hurt by it. They get laid off, et cetera, et cetera. And the Fed is more or less the instigator of it. And then once it starts to break, the bubble that they created starts to break, they try to hose it down again with more liquidity, which helps create the next bubble. The problem is this time they've created the biggest bubble in US history in terms of certain paper assets. And if you look carefully at the markets, you'll see that there's certain paper assets that are not rising back to the 2022 highs. The banking sector, oh, we can ignore that, right? Okay, sure, okay. How about RWR and VNQ? Those are two ETFs of REITs, real estate investment trusts. We know that commercial real estate is hurting. It's strangling because of the high, especially the long end of the US debt market is strangling them. And a recent drop in the bonds is not helping rise in yields. Those charts are nowhere near back to the 2022 high. In fact, they're in the lower third of the last 3 or 4 year price range and looking very anemic, like they want to start to roll over again. So that's a factor that could definitely spark the Fed into, again, another boom effort. Their boom efforts never work. They cut rates all the way from 2007 to 2009. The market collapsed anyway. They cut rates from 2001 to 2002. Market collapsed anyway. So I think there's some other economists out there who aren't of my view. I'm a libertarian, going 50 plus years back, in fact. I see no need for a monopoly government force in the creation and the pricing of money. Just like any commodity, it should be freely priced in by market forces, meaning rates are determined by supply demand, not by some academician sitting up there with all the power in the world. And when they think they know reality better than we do, they create problems because they're usually never right anyway. And I think there's enough economists out there, even of the pro-Fed bias over the years, who are beginning to doubt the viability of the institution. You know, a lot of them are saying you went too far, you went too far. You know, they're even giving up to some extent on the Fed. And if this stock market breaks, as we think it's about to, I think Q3 we're going to see the downside begin again. This time in a way that's
Q3. So I mean, we're only a few days into only a few days into Q3.
Right,
so we're
correct.
within the next 3 months we're going to see.
Yeah, I think you're going to see a lot of this occur before the election. That we're going to get a large down in the U.S. market. I'm not forecasting a crash or anything of that sort. You don't necessarily have to have a crash in a bear market. You know, the 2000 to 2002 never saw a crash. Saw a wipeout, but not a crash. But anyway, I think that there's enough doubt out there, intellectual doubt among academicians and economists, that if we go into another crisis and the Feds, they see again the Fed was lagged or helped cause it or whatever, there's going to be some doubt. And, you know, there's also many people who are running for office right now who just as soon abandon the notion of a monopoly government monopoly over the creation and pricing of money. So I think if you break the stock market, it's going to create that pain. It's also going to create academic thinking about, is this institution really viable or is it a causal factor? After all, it's only been around 100 plus years. It's not like it's something that's been around forever. I think it could be shrugged off very easily. And I think in the next crisis, it will be.
Do you think we won't have a Federal Reserve in the coming years?
I don't think you will have one. And I don't think you need to have one.
And the
And
market just goes back to pricing money itself,
well, I think you made a
supply and
lot
demand.
of, I think there's going to be a lot of currencies in the world that will go back in the coming year or two or three.
Right. Okay.
And in which case, any country that goes to a gold back currency is to some extent saying, we're not going to control the quantity and the pricing of money.
You don't need a central bank.
Yeah. Gold is, you can't infinitely expand its supply overnight by pushing a button. And I think this is underway. And I think as the next crisis hits, the collapse of the bubble, our bubble especially, again, not China, not Europe, et cetera, that will bring a lot of new ideas to the surface, including one that says, hey, we don't need these guys.
Do you think that the States will be at the front of that queue or towards the back? I mean, in terms of hanging
Oh,
on to
I think the
their
discussion of the
central bank.
dismissing of the Fed will be something over the next several years. I don't necessarily right away, but
Sure.
this next downside will demonstrate that they're not in control of JS. Okay.
Yeah. I think I know the question was more, do you think that that other countries would be the first to take an action like that, or do you think that the US would be?
Oh,
Would
you
they
mean
be
abandoning
would they be
it?
thought leaders in it, or would they be thought followers?
I can't address that. It's possible that there's some European academic forces and that are also intertwined with politics that remember the Weimar Republic and have a different view than what the EU has had over the recent decades. And therefore, some of the upheaval you're seeing in Europe and certain countries here and there, which are sort of anti-centralized EU notions, that could be accompanied by, we don't necessarily need an ECB.
Sure.
We need to cut its power. So it may occur there first.
Sure. So there's a hyperinflationary historical memory that exists more so in other countries that might.
Sometimes academicians do have some solutions that when people are in pain, they say we need something else, and they're writhing, so to speak. And somebody says, "I've got an idea for you." Okay, so the people are looking for a new idea once they're inflicted with pain because they know what has existed hasn't worked.
Sure. Sure.
And therefore something else. And that's when, well, for instance, the von Mises Institute, which is Austrian School of Economics, which is headquartered in the US, a think tank, they had a full-page ad in the Wall Street Journal a week or so ago. Who needs the Fed?
Okay.
And it's an intellectual discussion of why the Fed should not exist.
Yeah.
Full page.
So these are open discussions rather than just kind of hypothetical conversations in smoky back rooms.
They're coming to the fore. And I think when the crisis hits, people will start thinking about, instead of tinkering with this or that, maybe we need to rethink the whole thing.
Yeah.
The crisis will help spark that thought process.
Indeed. And this crisis, and you see that potentially in this quarter that we're going to see some significant moves lower in the stock market. Is there going to be a particular catalyst that you've identified that'll
we're watching? Yeah, the yen could be one.
Okay.
Because it could cause the Fed to cut. And as I said in the past, if you shorted when the Fed cut back in 2001, yeah, there was a brief rally, but you nailed a good spot to be shorted. If you shorted it in 2007 when they cut rates, you missed the high by 4 weeks. Okay. So the yen could become a new surprise factor, but also we're closely watching the vulnerable sectors that can't be allowed to collapse, such as commercial real estate.
Yeah.
Janet Yellen, our Secretary of Treasury, says, "Oh, quote, I realize there's a problem in commercial real estate, but it's, quote, manageable."
Sure.
This is almost precisely the same words that Bernanke used talking about the mortgage crisis back in 2007. He said a term similar to manageable.
Nothing to see here, basically.
And of course it wasn't. Okay.
Yeah.
So watch the commercial real estate market. We're watching it closely technically. And frankly, if it drops about 1% or 2%, it's going to start breaking some big momentum trend structures. Can't see it on the price chart. If that starts down, it'll suddenly become a dominant factor again. It's lost, it's lost when you only talk about NVIDIA. Okay. And even NVIDIA is looking vulnerable. But you break some of these sectors that can't afford to break, that will have wave effects.
It take down the banking system.
Yeah, so the banking system will follow the commercial real estate. And so you can talk all you want to about certain AI stocks, but as valid as the concept of AI is, just as the notion of the internet was totally valid back at the 2000 .com bubble top, In fact, it was far more valid and productive for humankind than anybody anticipated even then.
Yes.
And yet tech sector went down 82% by 2002. Okay, so factor that into your thought process, but watch these other markets that are too important to ignore, because that's what's going to spark the Fed or break the Fed into having to panic.
Just want to touch on something you talked there, obviously, about gold and the idea of a gold-backed currency being adopted in a number of places around the world. Do you see in the gold market, do you see that the movement into gold continuing between now and when we see a potential gold-backed currency?
Yeah. I think it'll take a crisis to finally provoke enough countries into going to the gold-backed route. They'll say, hey, you know, this other stuff hasn't worked for the last 60, 70 years. The central bank total manipulation of monetary reality. We need something more stable. And, you know, who knows, maybe the Chinese will lead. You know, it's hard to say, but you can sense it out there that it's coming. And I think the crisis, particularly the breaking of the US stock market bubble, will help further that. And I also think that the price of gold is likely to go parabolic.
Okay.
No more of this arm wrestling, you know, 2 steps forward, 1 step back type stuff. And I think if, for example, gold right now is 2340 area, you know, it's been above 2400 in May and June, and again in July. It might be over there, April, May, and June, and maybe July, it'll be above 2400 again. If you go up over 2400 again, my bet is gold starts to go parabolic. In which case you don't move in hundreds, you move in, you know, you could move $1,000 very rapidly. And I think silver will outpace it. And I think that in the next 6 to 9 months, you could see something there that is jaw-dropping. Right. And it will also be, it won't be on its own, though. It's already led what I think is about to happen. It's anticipated that the breaking of the bubble will cause the central bank to go berserk, meaning monetary expansion. Once that starts to occur, then gold will know, aha, yeah, I was right. And the people that bought gold years ago will say, aha, I was right. So,
and is it a case then for investors that it's kind of Tina, there is no alternative then to precious metals at that stage, or
not crypto either? No. And Bitcoin, as far as we're concerned, over the last 2 weeks did damage to itself.
Okay.
And I don't mean on the price charts, but I'm talking on long-term momentum broke a structure that goes back 2 years. In other words, you could plot a multi-point uptrend. You cannot do it on the price chart. Price chart sort of went upward curvature. In fact, made a new high, quote unquote, just like the stock market did, by the way, over its 2022 high, so did Bitcoin. And no sooner did Bitcoin take out that high than it said, oops, what's happening? Nothing happened. Now you're well back below it. It's like I had a breakout that didn't matter. Okay. And I don't think it did, because now you've broken some momentum structure. Well, what does that mean? It means that those who are seeking the cryptos as an alternative to fiat currency or find that that alternative is not behaving as they expected. It's not the alternative. In fact, it's behaving more like the NASDAQ 100 than anything, in our view. So I think gold will be pretty much gold in the monetary metals, silver, and the miners as well, will be pretty much the only, when people look around, they'll see that's the only one. And so far this year, it's been a standout, you know. I mean, yes, the S&P's up, S&P and NASDAQ up in the teens percent year-to-date growth. Silver's up 21% year-to-date at its high. No, at the June close, excuse me. And gold's up about 13% year-to-date. So doing pretty well. Yet nobody's pounding the table about it.
Before we let you go, can you tell our viewers a little bit more about where they can find you?
Well, it's our website's Oliver MSA. MSA stands for Momentum Structural Analysis. Go on the site, you could find out more about our methodology or history, a lot of archived reports on the stock market in particular, and explanation as to, you know, what we cover. We cover all 4 major asset categories, because it's very important now not to just look at, let's say, gold or silver, or just look at the stock market. These are tectonic plates bumping into each other, and they're impacting each other, whether negatively or in agreement. So it's important to look at that. And we cover all 4 of those in our major subscription. We also have a subscription just on gold, silver, and the miners. anyway, so tour the site and ask for some sample reports if you'd like.
Super. Well, listen, I've thoroughly enjoyed our conversation today. Thank you for coming on the channel. I'm going to stick a link to your website in the show notes and description below this video. So anybody that wants to click on that, I highly recommend that you do. But for now, Michael Oliver, thanks for joining us on the channel.
Thank you, Dave, very much.